Thanks for joining us today on The Close. I'm Morella Fernandez. Markets close in a half hour's time. Let's get to the stories we are following out of the BNN Bloomberg newsroom. Canada recorded its first trade surplus since the beginning of the year, driven by a rebound in exports. StatsCan shows a recorded surplus of $153 million in September, following a deficit of more than $6 billion in August. Exports of metal and mineral products spiked. Canada's trade surplus with the U.S. widened to $8.6 billion, marking the largest since February. Shares of Empire are falling today after the company missed estimates on adjusted profit. The Nova Scotia-based grocery chain owns brands like Sobeys, Safeway, Foodland, Farm Boy, and Freshco. The company says it had higher staffing costs and spent more on store upgrades. However, it wasn't all bad news. Empire reported a slight beat on sales for the quarter. Shares of Dollarama are up today. The Canadian company reported a 22% spike in revenue in its most recent quarter, beating expectations. The discount retailer also posted higher profit and same-store sales that exceeded estimates. The boost has led the company to increase its 2026 outlook for Canadian same-store sales. Shares of Walt Disney getting a lift today. The company investing $1 billion in OpenAI. And as part of the agreement, more than 200 Disney characters will be allowed on OpenAI's generative video and image platform. In return, it will use OpenAI's models to build new products, tools, and customer experiences. Here is where we are on the markets today. The TSX poised for another record close. It's 171 points up so far at 31,662. That is a new intraday high. South of the border, not a great deal of change for the S&P 500. The Dow Jones, though, gaining 657 points on the day, 1.4%. The Nasdaq down close to 100 points right now, 0.4 of 1%. Empire, the company behind Sobeys, reported its latest quarter, which saw a profit of $159 million, down from $173 million in the same quarter last year. We got more on the results from Chris Curlow, Senior Portfolio Manager, Investment Advisor, Canaccord Genuity.
The stock's kind of been in a bit of a downtrend lately, not doing too well in this post-tariff era. The grocery business in general is a very low-margin business. Tough to make a lot of money, so when those profits get crimped, it makes it harder to keep doing what they've been doing. It's not something that we've owned. It just doesn't screen well. We look for high-paying Canadian dividend stocks, and it's got a bleak dividend, so not a name that we own in the LWC Canadian dividend portfolio.
Yeah, so it said expenses were up, employees and wages was an issue. Does any indicators that they might be getting it under control, or is it?
It seems to be a lot of the same problems. I mean, wage growth in Canada, it hasn't subsided. It's one of the drivers of inflation. The automation and the AI productivity gains that we're seeing in other sectors just really isn't there for grocery just quite yet, probably a 2027 story. So doesn't seem like this is a buying opportunity at this exact moment. But like I said, not a name that I followed too closely just because it doesn't really fit into the criteria we're looking for.
Any in that realm in the grocery store area?
Consumer staples in general is just an underweight for us. Just not a lot of companies in Canada in the space in general. It's a couple grocers, cheese company, stuff like that. But so we've just been underweight staples. We benchmark more the TSX Canadian Dividend Aristocrats category, which has a pretty low staples weight in general.
All right, we're going to get to some of those stocks you want to look at, but I want to talk a little bit also about Oracle. It's down today. Your thoughts on that?
Yeah, I mean it's part of that center of the AI universe. They have the big OpenAI contract. It's been under pressure since they started raising debt to meet their data center obligations. We look closely at the bond market when analyzing a company. It tends to be a great leading indicator, and the CDS spreads have been widening out for quite some time now, even further here. And if their debt moves into that triple B, high yield category, I think that could be possibly another leg down for the name. Legacy business that's trying to catch the wave here and just hasn't been a leader in the space.
How close is it to that triple B?
I believe it's bordering it at this point right now, just looking at it briefly this morning.
Yeah. What would it take to kind of redirect that and reverse it?
I think it's just such a competitive area. It's probably late innings for a lot of these AI names. We added recently to NVIDIA kind of the toll collector on the toll route of the whole data center game. Mm-hmm. A lot of headway or noise around kind of the competition around the GPU space from AMD, the other hyperscalers building their own chips. But, once a developer starts using CUDA in their tech stack, it's a very high switching cost. And you can get NVIDIA today the same price you could in the summer. And with their data center business growing at 100%, I think, fundamentally, we thought it was a good time to put a bit of chips behind that idea.
All right, so you're liking NVIDIA right now. Let's talk a couple of the stocks you're focusing on. CF Industries.
Yeah, that's when we got off, actually. So we've been in it for a while. They've made some inordinate profits during 2021 to 2023 during the Ukraine-Russia problem. They're one of the largest nitrogen fertilizer companies in the world. And so there's kind of this arbitrage between U.S. natural gas and European natural gas where they can create these products in the United States and ship them overseas. That game's kind of been fading with some resolution on that side. And so we've just rotated into Nutrien, Canadian, market leader here. They do the nitrogen game and benefit from some of those tailwinds that I've mentioned, but it's a much more diversified business. They have a retail focus, obviously out of Washington, trying to support farmers south of the border. That's great for their largest output, which is potash, and so following the acquisition of Potash Corp here in Canada. And so we see that after years of kind of underutilization, that demand picking up there. So it's just kind of a pair trade into Nutrien from CF Industries.
Any concerns with Nutrien with the potential tariffs on fertilizers?
Yeah, I mean,
the mentioned tariffs, they seem to have faded away from the start of the week.
Yeah, totally. I mean, it's kind of like one or the other. Like, you want to support farmers, but you want to increase the price of what they need to do their job. So I think it's going to be challenging. Canada, we're the largest exporter in the world, maybe outside of the national company in Belarus. But I think it's going to be challenging for them to lay the tariffs on that. Obviously, it's made some headlines here, but solid valuation, good dividend, screened really well. We got it in the low 70s. I think below $80, it's a very interesting name to be in a portfolio. Okay,
a couple others. We were talking about NVIDIA, but Freeport, McMoran. Is it McMoran or McMoran? I always get it wrong.
Freeport McMoran.
McMoran, there
say it real quick and no one knows.
McMoran. Yeah. Freeport.
So Freeport, largest copper producer in the world. Love the copper play. It's the backbone of everything, industrialization, the Internet of Things, this AI trade. We've been in the name for a while. We added to it in September when they had that mudslide at one of the largest mines in the world. That kind of slowed supply, and so we added then. It faces a lot of technical resistance here in the mid-high 40s. Mm-hmm. So we've been pairing it off, rotating into some gold names that we like. So not fading the material space in general, but just think that Freeport struggles to kind of break above $48, $50. So yeah. And so
you've been moving over to Alamos?
Yeah, great story, good visibility on them increasing production 25 to 27% in the next couple of years here. With gold stabilizing around $4,000 an ounce, it's a fantastic space. Great hedge against this U.S. currency debasement, which has been picking up steam, something we've been talking about for a few years now. Gold's been a huge part of our overall asset allocation since the summer of last year. And so with Alamos, you could see the stock kind of trending sideways there. We thought it was okay to increase we had taken profits and just kind of came back to a full position on that name.
Chris Curlow is the Senior Portfolio Manager, Investment Advisor, Canaccord Genuity. Canada posted a surprise trade surplus in September. We'll dive into the details when we come back. In a surprising turn, Canada has recorded its first trade surplus since January, driven by a rebound in exports. Data from StatsCan shows the country recorded a surplus of $153 million for September. Let's go to Bloomberg's Ottawa bureau chief, Laura Dillon-Kane. She's got more on this. Laura, I know information was delayed by that U.S. government shutdown, but what did trade look like with the U.S., first of all, in September?
Right. Well, again, kind of surprisingly, exports were up. Despite the U.S. slapping these steep tariffs on Canadian steel, aluminum, lumber, and autos, the USMCA exemption for broader trade between Canada and the U.S. has really proven to provide some stability to Canadian businesses and exporters. And so we certainly exported more metals, and we exported more oil as well. And we know that a lot of those products are going to the U.S. We exported more gold as well. I mean, that was the primary metal that we exported more of on the month in September. So sort of the political instability of the U.S. and sort of the broader geopolitical picture is contributing to Canada exporting more gold as investors do flock to that safe haven metal.
Okay, so that was the picture with the U.S. What about other growth nations for trading in Canada, with Canada?
Yeah, we also expanded our exports to non-U.S. countries in September. It was overall a pretty surprisingly strong month. We exported more gold again to Switzerland, and we exported some oil to Germany, and oil and aircraft to Singapore. Those were some big exports that we did to other countries. And so overall, our trade deficit with non-U.S. nations narrowed quite substantially. And then we, of course, recorded that overall trade surplus with the world for the first time since February. Yeah. Or January, rather. So, overall, a very strong picture, relative to kind of what we expected, given the steep U.S. tariffs. At the same time, though, we did see imports decline, and quite substantially, and that's not necessarily something to cheer about because it does suggest that domestic demand in Canada is quite soft.
Yeah. All right, we will leave it there. Bloomberg's Ottawa bureau chief Laura Dillon-Kane with the latest on trade in this country. Coming up, we'll get an investor's perspective on that latest trade data when we come back. Canada, as we mentioned, reporting a trade surplus for September, the first one since January, and the start of the trade war with the U.S. Let's talk about this with Carl Berger. He's a senior wealth consultant and investment counselor, Stidel Asset Management. Thanks for joining us today.
Nice to be here.
So not a big surplus, 153 million, but it's a reversal from that big deficit we saw in August. Why do you think we saw a bounce back like that?
I mean, it'll be interesting to see as we go forward, Morella, whether this was just a bit of an anomaly. It's a volatile series of data. It was actually a good number right across the board, as your previous segment noted. As important, though, obviously, will be what happens over the course of the next number of months. So I don't think anybody should claim victory at this stage. There's still lots to happen as CUSMA gets renegotiated, or if CUSMA gets renegotiated, and what form that takes. So there's a lot to come still.
Okay. When you look at both the jobs data and the GDP data in Canada, both surprises to the upside, do you think tariff concerns are over?
No, absolutely not. What this says maybe is that people have been extremely negative on Canada to this point. And perhaps there's a glimmer of hope that things won't be quite as negative as we might have believed over the course of the last 6 or 12 months. And if you look at the performance of the TSX over the course of 2025, I don't know that many people would have expected what we've experienced or what we've seen out of the TSX, given how dire the tariff situation was likely to be for Canada and may still be. But we're at a far better place, I think, in the last couple of weeks, or the data from the last couple of weeks is showing that we might not be in as bad a place as many people would have expected at this stage. And that's showing up in the currency. It's showing up in interest rates. And it might mean that investors need to change the way they're thinking about the Canadian portion or the international portion of their portfolios. Again, it's a little bit early to draw any fast conclusions because they are very volatile data series, and it's a pretty tricky time still. But there's some interesting things going on.
Yeah, the Bank of Canada decided, as you know, to hold the lending rate, given, as you say, it's a tricky time, and the data is the data, which could change very quickly, as we see. Was it the right time to just hold the rate?
Oh, I think so. And remember, too, that the Bank of Canada is far, far ahead of the Federal Reserve in terms of that easing path. We've been on that path for the better part of 12 months now, and maybe even a little bit more. The U.S. is much more recent into that cycle. So Canadian interest rates are quite a bit lower than the U.S. and have been for some time. We've had the benefit of a very, very weak Canadian dollar relative to the U.S. dollar for some time. In my experience over the last 20 or 30 years, that always or usually creates the conditions that ultimately support a stronger Canadian dollar. So maybe we're starting to see a little bit of that. But at this point, it looks fairly clear that at the very least, the divergence where Canada is easing more quickly than the U.S. appears to be over. And now maybe we hold steady for a little bit while the U.S. eases in the short end of their curve.
We had earnings today from Dollarama, 22% spike in sales. Are consumers still being cautious? Are consumers still being careful? Do you think this is part of the story for Dollarama?
Yeah, I think it's a big part of the story. They're also doing a brilliant job in terms of execution of their domestic and their international strategies. But Dollarama is very, very well placed to take advantage of a stressed consumer, let's say. And so if there's all kinds of price pressures in different parts of a consumer's world, naturally they're going to gravitate to a place where they can spend less money if they have less. And Dollarama has done very, very well at exploiting that. It's an expensive stock at this stage from a valuation standpoint, as you might expect when a stock is up to the extent that you'd see on that graph there over a fairly short period of time. But a very, very well-run company at this point, and we're quite comfortable holding it.
The strength in tech has helped investors in North America quite a bit this year, pushing them up. That being said, AI-related stocks have seen some pressure probably since November now. Is it time to rebalance ahead of 2026? How are you advising at this point?
I think every investor should take a look at how their overall portfolio sits, and liquidity that they might need over the course of the next 6 or 12 or even longer months, just based on what their personal situations suggest. The AI and tech boom is so fascinating because there's been an awful lot of money spent in tech. There's going to be an awful lot more money spent in the tech space. Our concern, I would say, not fear, but our concern is that at some point there'll need to be a pretty significant return on that investment in order to incent these companies to continue to spend more. And it very likely won't be linear, which will create some volatility. And so at this point, we're seeing a bit of a pause over the last 6 weeks or so of what has been a very, very strong trend, really since Liberation Day on April 2nd, when the tariff surprise first came down. Since then, we've had pretty smooth sailing in terms of the markets and the inflows, capital inflows into it. So not at all surprising that we'd see a little bit of a hesitation at this point and maybe a bit of a retracement. But again, there's an awful lot to happen in the early part of 2026.
All right, Carl, I'm going to leave it there with you. I'm out of time, but thank you for your time. I appreciate it.
My pleasure.
So Dollarama raised its annual sales forecast when it did report after meeting expectations for the latest quarter. BNN Bloomberg's Lindsay Biscaya joins us now with more on that. Tell us more about their report.
Yeah, well, it was a good quarter for Dollarama, but most of these sales we're seeing this increase is particularly driven by demand in Canada. So Dollarama saying that accounts for more than 90% of Dollarama's total sales. That's Canadian shoppers going into stores. And the company says it's seeing more shoppers coming through its doors more often, buying more stuff. So when we talk about the third quarter, net sales up 16%, quarterly sales up 22%. And when it comes to Canada in particular, comparable store sales increased by 6%. It's interesting to see the kind of rollout here. Obviously, this is a Canadian company, Quebec-based. Currently, there's more than 16,000 stores in Canada. In the last quarter alone, 19 new stores opened. Throughout the whole of 2025, 65 new stores opened across the country. And of course, Dollarama also rolling out stores. They're kind of focusing on rolling things out in Latin America and in Australia. Those are under different names, though I believe in Latin America it's Dollar City, and then Australia it's the Reject Shop, but they're under Dollarama is the owner of them. And so it's really been interesting to see this kind of spike, obviously showing consumer demand right now. I know your guest was just talking about that a little bit, that people are looking for those alternatives when it comes to finding cheaper options, because we've been seeing all these retail earnings reports coming in from different retail owners talking about how higher consumers are still spending money, higher income consumers. But when we're talking about lower income consumers, they're probably looking for the cheaper options like a Dollarama, where you can get basically everything at this point.
I never understood the appeal of calling a store the Reject Shop, but on
I don't understand that either. Yeah.
Let's talk about the forecast for Dollarama. Now we know where they stand. What are they saying about moving forward?
Yeah, so moving forward, Dollarama expecting to perform even better than expected. Again, this is actually specific to Canada. Comparable store sales, they raised their comparable store sales target to a range of 4.2 to 4.7%. That's up from about 3 to 4%. A gross margin expected to increase slightly as well, and capital expenditures are expected to be lower. So outlook is looking good for Dollarama. A lot of economists today putting their rating at an outperform or a buy for the company. The stock down right now, but earlier it was up. And if we look in the last year, it's up 39%. In the last 5 years, up 269%. Obviously, the COVID era kind of boosted Dollarama up even more as people were looking for alternative options. But the future, so far at least, according to Dollarama, looking bright.
Yeah, 38 and a half up over the year. Not bad at all. All right.
Not bad at all.
Thanks, Lindsay.
Thanks.
All right, last look at the markets before we end the trading day. The TSX set for another record close, passing what it closed at yesterday. 31,649 is where it stands right now. That's a 158-point move up, or 0.5%. Not a material move for the S&P 500, and the Nasdaq dropping 85 points so far on the day. The closing bells are coming up next on Bay Street and Wall Street. Stay tuned for that. Here are the closing bells for the end of the trading day. At the Nasdaq, Park Dental Partners ringing the bell. In New York, Black Hills Corporation ringing the bell. And at the TSX, the TMX Charity Golf Classic closing the day out. You're watching The Close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. And yet another record close for the TSX, gaining 169 points today, or more than 0.5%, and ending the day at 31,660. The S&P also a record close by 1 point today, although that just moved, so we'll have to double check that. It gained 14 points, ending the day, it looks like, at 6,900. The Nasdaq dropping 60 points today, down about 0.25%. Let's get to the movers in Toronto. We're going to begin with TerraVest here, which gained over 22%, or $28.66. They make transport trucks. As you could see, shares moved up, and it's up 27% over the year. Stephanie Hughes from Bloomberg is going to have more on that story in just a moment. Perpetua Resources also gaining today. It's up 13.5%, a gain of $4.79 to $40.21. New Gold gaining today as well. It jumped over 9%, taking it up 98 cents per share to $11.76. It's up 184 in the last year. And then First Majestic Silver also gaining close to 7%, or $1.50 today. Now in the red on the flip side, Empire, owner of Sobeys and Farm Boy, dropping 9%, losing $4.71 a share to $46.52 to end the day. And let's get here to premium brands. It is also down today, dropping more than 6%, almost 7%, and losing $6.94 a share. Let's go to Bloomberg's equities reporter, Stephanie Hughes. She has more details on the movers. Stephanie, TerraVest, what led to all that enthusiasm today?
Yeah, that's a great way to express it, Marilla. There was a lot of enthusiasm around TerraVest today with the surge as much as over 26% at its highest point, which by far made it the top performer on the TSX today. And it was also its biggest move since 2012, so it's been over a decade since we've seen a move of this magnitude. TerraVest, a developer of transport trucks for propane and natural gas, that company reported fourth quarter results that came ahead of what analysts were expecting. Both the adjusted earnings and revenue beat by a healthy lead over what the consensus was looking at leading up to these results. But the company said that the sales were supported by higher service demand, HVAC, what have you. But the reason why the share price reaction was so huge was because of analysts, including the team at Scotiabank, flagged big concerns leading into the quarter around its Entrans trailer business, just because of U.S. peer Wabash National posted a big earnings miss. So there was some fears that there'd be some read-throughs from the U.S. market into Canada here, but that just didn't come to pass. TerraVest actually had a pretty big earnings beat. So Scotiabank's Jonathan Goldman said that the big beat should actually be a clearing event to help shares really gain. And what a gain, just looking at that 1 week chart there. It should be a clearing event for the company's depressed shares. And with this healthy double-digit lead, I think this company has been playing a bit of catch-up today, Marilla.
Okay, let's talk about Empire as well. On the flip side, after their earnings report, what did the company have to say?
That's right. Yeah, so a completely different story for Empire. Those shares tumbled by over 10%, which was its biggest drop in 2 years, dragging the shares down to levels not seen since April. And like you alluded to, worst performer on the TSX today. And that's because the grocer did miss analyst estimates by just a penny. It was just a penny short, but TD Cowen flagged that the real problem here is that once you take out a one-time $8 million benefit from Sobeys' litigation settlement with the CRA, then it's actually closer to a 10% miss. So that's been given a much less forgiving reaction from the traders, because just being a penny short shouldn't be punishing the stock this hard, but there's some financial accounting underneath there. So Scotiabank said that, Scotiabank on the other hand too said that the EBITDA was also weighed by higher costs, and grocers just in general have been reporting lower same-store sales growth over the last few quarters. So that's just a sector concern as well. So there's a few things working in tandem to weigh on Empire shares and put it in the red today, Marilla.
All right, we will leave it there. Stephanie, thanks for the update. Let's check in on movers south of the border. Bloomberg senior equities reporter Bailey Lipschultz joins us now to talk about that. Bailey, Oracle, we know, reported yesterday investors have concerns about the debt and AI spending. So what happened today?
Yeah, we saw the stock under pretty sharp selling pressure. Obviously, this happened yesterday after the bell and continued throughout the company's earnings call. The big question coming into the print for Oracle was, are you going to slow down AI spending? And at some point, will we see returns on that investment? The answer is no to slowing down on spending, and not yet on seeing returns when you look at kind of capital expenditure, really looking at their data center spending. About $12 billion in the quarter. Analysts were looking for $8.25 billion, so well above what the Wall Street crowd was penciling in. Biggest intraday decline, biggest closing decline since January. As you can see, really the steam coming off the engine since late October, early November, when we saw kind of the positioning away from a number of these AI companies, but in particular has been Oracle. When you look at a market that really picked up some steam, broadly speaking, it does seem like maybe Oracle is idiosyncratic. Now still only up about 20% this year, so a good performance. But all things considered, if you bought at the top, you're down about 45%, and really hoping that at some point either the company dials back that spending or ultimately delivers. And we saw kind of that weakness leak over to the likes of a CoreWeave. So still seeing a divide between the haves and have-nots, or at least the companies that are living up to expectations in some degree. And Oracle right now is not one.
All right, let's get to Robinhood, also under some pressure today. What pulled that stock down?
Yeah, they also reported results recently. Selling pressure, not as good of growth as investors maybe were expecting. We saw less follow through, whether it was on their options or equity trading. Also, we saw dial back in terms of some of the assets under management. Partly that is driven by crypto sell-off, obviously. But when you look at it, this is a stock that has been absolutely crushing it so far this year. So even with that pullback of more than 7%, it's still up tremendously from where it was in January, and really not that far off from those recent peaks. So maybe investors rotating away, taking some gains off the table. The big thing is we see with a number of these high flyers is when earnings happen, even if they beat expectations or are not that bad, we do see some moves to the downside just because people are booking those profits. And again, we're getting close to the end of the year, so maybe closing out some positions on the portfolio as it relates to Robinhood.
Okay, let's get to Rivian. They do automotive vehicle technology. It's going to make its own AI chips, but the shares are falling. So investors didn't like that?
Investors didn't love it, as we were talking about with Oracle. When you look at kind of CapEx and spending and expectations, really the big question is, what does that ultimately look like to the bottom line in the business? Rivian has been trying to drive forward as it relates to manufacturing and selling cars, and as you can see, has been challenged this year. If you really step back and look at where the stock is relative to when it went public back in the kind of peak of all this mania back in 2021, it is nothing but really down and to the right. So the big question mark is, what does this chip ultimately look like? What are the costs going into it? And are you able to actually compete with companies when you implement this technology versus it being an interesting headline and maybe more of a side project?
All right, Bloomberg's Bailey Lipschutz. I got to leave it there, sir, but thank you for joining us. Appreciate it. And straight ahead, the Nasdaq ended the day lower after Oracle's earnings from yesterday. Are investors still concerned about a bubble? We'll talk about that in a moment. The U.S. Federal Reserve cut the lending rate, a move that was widely anticipated. Let's take a look at how that played out today on the markets with Phil Blancato. He's chief market strategist at Osaic. Thanks for joining us today.
Thank you for having me.
What kind of reaction did you note today?
You know, what was fascinating to me was we finally saw interest rate sensitive securities begin to have, or really continue to have, their moment. Think about the rally in small caps, the positioning in value stocks. You're seeing this opportunity for other areas of the marketplace really grow. And that's one of our themes for 2026, that the broadening out of the market, you're seeing concerns around AI spending, AI revenue, AI application. So other areas are going to have that opportunity. It's interesting for not only for the bond market, specifically for the bond market, but also other areas of the marketplace, and small caps is a great example of where the market's going.
Okay, the Fed indicating the bar is going to be higher for any other rate cut in 2026, but there's also a change of guard next year. So what's your expectation in 2026?
The front end of the curve is still a bit too high. If you look at where the real lending rate should be, the natural rate, if you will, it's probably somewhere around 2.75%. With the front end still up there between 3.5% to 3.75%, we need to see another 0.5% come out of the front end of the curve next year. So I think 2 more cuts for next year. I do think there's probably a pause in January, let some capitulation happen. It wouldn't surprise me to see something in that March, April timeframe, and then we'll see where we go from there. But with the new Fed governors, new Fed chair, there's going to be more of an appetite to cut. I think we get 2 more cuts next year. The market's going to anticipate that, and that's why I think you're going to see real success in the bond market, and real success in interest rate-bearing stocks, or stocks that care about interest rates.
Okay, but that being said, what kind of data do you think it would take to get there? Clearly, Jerome Powell was concerned about weakness in labor and some softening there. Would it take more layoffs, for example, for that to happen?
You make a great point. This is very critical. There's 2 ways to look at this. If we get softer inflation data and a moderate employment market, then that, to me, is exactly the Goldilocks moment that we want. But to the other side, if we get a weakening labor market and they're having to cut the state of the labor market, very different narrative. Then we're looking at a scenario where we probably see a pretty significant sell-off on the equity market. We see a piling into fixed income, and that would be a concern. That doesn't seem to be the case. I think you get some more deflation from AI. I think you get some more deflation from our demographic makeup in the United States, some deflation from the post-tariff world or less tariff impact. And that scenario to me gets PCE down to 2.4, 2.3, and that's the reason to cut. However, if to your point, if it's because of a weakening labor market, that's a different narrative, and I would have great concerns for the equity market, especially at these valuations.
All right, let's get to a couple of your stock picks. You like Morgan Stanley. What makes it stand out over other financials?
There's a few things they're doing well. When you think about the diversified revenue line they have is exceptional. But when you look at their earnings growth, it's really very impressive. You look at their net interest margins, one of the best in the industry. And you look at a company that not only has made recent acquisitions that really bolster its bottom line, I think you have a not exceptional earnings growth profile. Now, I know the stock's done well, but in a time when banks are going to really benefit from deregulation, I think this is a name that you can own, hold for a long time. Not only their organic growth, the acquisition, but certainly from the diversified revenue stream is a reason why you want to own this stock.
All right, let's get to another pick of yours, which is FedEx. But trade has thrown off package delivery, right, across North America and really you could say around the world. Why do you like FedEx? And is it using AI in any way to drive efficiencies?
You're making this easy on me. There are three reasons why I really like this company. One, they took $1 billion in debt out. Two, they pay a wonderful dividend, 5% dividend. You know, folks, when we've forgotten how valuable it can be to be paid to wait around. Start the year with a 5% dividend. That's very impressive. And the third one, you hit on it. I think AI really bolsters their opportunity to increase their profit margins. We're wondering when AI will add to the bottom line of companies. This is a great example of using AI to better meet their supply chain issues, better meet their delivery issues, to control their staffing. So I think the AI application here makes a profound impact on their revenue. And for those three reasons, you want to own the stock.
Your last pick is Southern Copper. They participate, I guess, in all stages of the process. Where do they operate?
They're mostly in South America. There's a number of countries in South America where they operate. And why I like them, we don't make copper in the United States. And at a time we're going to do a gigantic rebuild of power grid in the United States, whether it's data centers to electrical lines and everything in between, you need a lot of copper, not to mention electric vehicles. So I think at a time when demand for copper is going to significantly accelerate, targeting a company that, one, has done a very good job of managing their debt. You look what they've taken debt out. They're Mexico, Peru, Ecuador, Central, South American focused. They've lowered their debt. You look at their price to book, very inexpensive company, and a company that can meet that supply or partially meet that supply chain demand for copper. I think it's a bit of a speculative play, don't get me wrong, but it's a name you can own and really benefit as this data center demand only accelerates in the years to come. You mentioned some of the data center numbers coming out of just Oracle alone and how much power is going to be needed, as well as data centers in general.
And let me ask you about where they are operating. We saw Peru, we saw Ecuador, we saw Mexico. Any challenges in those markets? We know that some of the miners are having challenges when they operate in certain other countries.
That's the speculation that you do have. Would you run into a tariff issue, and would you run into simple challenges around the country that they're based in, political headwinds, and then more importantly, can you get an agreement with not only the local population to be able to continue the mining, but with the United States? I think you got to take some risk in your portfolio. That's why I put this out as a riskier name. But it's something we have to have, not want to have, something we have to meet this AI demand that's happening. So that's really my driving force here. And in a world where you're going to need this copper supply desperately, you're going to have to get it from somewhere, and I think they can be a player in that space.
Phil Blanclato, appreciate your time, sir. Thanks for joining us today.
Thank you.
We've got the latest earnings coming into the newsroom from Lululemon. Investors looking, of course, deeply for a sign of a turnaround. The company, once a darling of the athleisure world. Lately, though, a lot of competition in the space. It's been struggling to hold on to market share. So let's have a look at how they did in the third quarter. As you can see, the stock's at $199.34 for Lululemon. First of all, the CEO, Calvin McDonald, says he's going to step down in January. He's also going to give up his board seat. So let's start there. Here are the results. Earnings per share coming in at $2.59. The estimate had been for $2.22, so a beat for the company there. Net revenue, $257, that's billion. The estimate was $248 billion, so the beat there in net revenue as well. Total comparable sales up 2%. The estimate had been up 0.72%, so they beat there as well. And Lululemon boosted its earnings per share guidance for the full year, going to $12.92 to $13.02, beating the average analyst estimate. Also raising its net revenue for the next year to $10.96 billion to $11.05 billion. The estimate had been at the lower end of $10.96 billion. So some positive numbers for Lululemon, but still a departure at the top level of the company. Coming up next, Broadcom's numbers just coming into the newsroom. We'll get an instant reaction to that when we come back. Broadcom earnings just coming into the newsroom. Let's take a look at what they had to say about the fourth quarter results. Adjusted earnings per share coming in at $1.95. The estimate was $1.87. Investors, whatever they're seeing here, are liking it because you can see shares are up after hours. Adjusted net revenue coming in at $18.02 billion. The estimate had been lower at $17.47 billion, so a very big beat there for Broadcom. Semiconductor solutions revenue, $11.07 billion. The estimate had been $10.74, so a big beat for them there as well. Infrastructure software revenue coming in at $6.94 billion, an estimate of $6.72 billion, so a beat again. And adjusted EBITDA coming in at $12.22 billion. The estimate had been $11.69 billion, so a beat right across so far. Adjusted R&D expense, $1.53 billion. Estimate had been $1.52 billion, so a little bit up on that. And then capital expenditure, which ends up being a key number for a lot of investors these days, coming in at $237 million. The estimate had been $153.6 million. First quarter forecast from Broadcom sees revenue at $19.1 billion. The estimate had been $18.48 billion, so an improved revenue outlook for Broadcom at this point. Let's go to Ivana Delevska. She's founder and chief investment officer at Spear Invest to talk about these results. Ivana, what metric is key? Is it semiconductor revenue that you're looking at here?
Well, thanks for having me. The two key things for Broadcom as we look into this report is going to be semiconductor revenues and networking, right? So I think the key is going to be to understand on their networking side, we already know that they're the leader. This is one of the most interesting subsectors of AI, networking. We think that's going to drive the next level of performance improvement. So that's really, we think, the core that's going to drive Broadcom going forward. On the same side, we have the semiconductor business, the XPU, and this is where they make chips for companies like Google. That's their main exposure today. And we're going to be trying to learn more about how strong is this agreement with Google and are there any risks associated with it?
Is the CapEx spending important for them as well?
Not necessarily to the extent that it's important for companies like Oracle. Remember, the business of Broadcom is relatively asset light. So they're really just expanding on their current footprint and infrastructure. So CapEx is really not that big of an issue here. It's really more in the case of the hyperscalers or companies that are like the neo clouds where they're spending large CapEx dollars. Investors are worried that they don't get ahead of themselves. But for companies like Broadcom, you can see it in the results. They're seeing the demand from across the board.
Has Broadcom confirmed a partnership with OpenAI to make custom chips? That was the discussion earlier.
Well, we believe that they're going to be making chips for OpenAI, but more importantly, the key here that's been driving the shorter term performance has been the Google TPU. And there's been a lot of news in the media and the press about how TPUs are gaining market share from GPUs. This would be positive for Broadcom. So really, they're very well positioned on the XPU side, specifically at Google, but at companies like OpenAI as well.
As you know, investors have been dragging down tech generally. Oracle reported yesterday and was sinking today. That company we know is deeper in debt. Broadcom, what is their debt situation, and do you expect that same drag on them in a longer term?
Well, what we're seeing is very interesting. If you look over the past 3 years, companies treated the AI investment theme as one. So all companies were trading together, whether you're looking at companies that are providing services or CapEx, they would all kind of trade in line and perform well. What we're seeing right now is a bifurcation between winners and losers. Companies that provide the picks and shovels, like Broadcom, are performing very well because you're really not taking that much risk on the AI cycle. Companies like Oracle, on the flip side, they're really supposed to be investing billions of dollars to power the next wave. And we believe that that's going to be successful as well, but there is significantly more risk associated with it. So as an investor, I think it's much better risk reward to stay with the picks and shovels. And we disclose all of our holdings on our website. So this is really where we're seeing most of the opportunities.
Okay, so you're saying stay with the picks and shovels. Do you think investors are taking their concerns out too widely, or is there some justification to their concern about overspending?
Well, there is definitely justification to their concerns, right? Because we do want to see at some point returns on invested capital. We go very deep in the investments that we make, and we do see those returns on invested capital. So if you look, for example, for AI specifically, in the early innings, we're seeing a lot of returns coming from recommender systems. These are like AI tools that are in use today. As we look forward, the key is going to be agentic AI. Are you seeing returns on agentic AI? We're not going to be able to know that just yet because the infrastructure required for AI agents is just putting in place right now. So over the past 3 to 6 months, we've just deployed the hardware, and we're going to be looking out for use cases and how these are ramping in the next 3 years. If that proves to be correct, then all of these investments will actually be justified.
But it's a 3-year cycle, you think, for us to see results from that next stage?
Yeah, so that's basically what we expect. I think this is going to be on a 1 to 3 year cycle. The first year, plus you're putting in the required infrastructure investment. And then in the next 2 to 3 years, you're looking for the use cases to be materializing. So we're seeing early innings of AI agents being useful, but they're not cheap enough to be deployed at wide scale. So this is why cost becomes so important. And this is why the TPU has gained such big traction, because it is performing relatively well on the cost side, specifically for recommender systems.
Got it. All right, Ivana, I got to leave it there with you, but thank you for your time. Ivana Delevska, founder, chief investment officer at Spear Invest. Coming up next, the U.S. trade deficit narrowed unexpectedly in September, reaching its lowest level in over 5 years. More in a moment. The U.S. trade deficit narrowed unexpectedly in September, going to a level they haven't seen since mid-2020, and driven by a surge in exports, likely supported by a weaker U.S. dollar and Donald Trump's tariffs. Let's go to Dennis Lockhart, American economist, former CEO of the Federal Reserve Bank of Atlanta. Thanks for joining us today.
Thank you for having me on.
Are the tariff plan, the big tariff plan from Donald Trump, is that working?
Well, it certainly is creating some concessions, I think. I'm particularly thinking about some of the investment commitments, but it's still having an effect on prices. And I believe that the tariff story as regards inflation is not over. It's yet to be played out, and we'll see some pressures on prices in 2026.
Why do you think so? Why is that an extended timeline for that price pressure to hit the consumer?
Well, it's hard to know exactly, but it appears to me that many price setters have been coping with the early months starting in April of the tariff situation. It was so erratic in its implementation, and there was so much uncertainty associated with it that I suspect many took measures in the short term, waiting for the tariff picture to settle into something more like a steady state when they would make their more strategic decisions on what their prices were going to be. So I think that The erratic implementation has more or less continued to this day, and there are decisions ahead on the part of price setters that will take place in the early months of 2026.
Okay, given that you think the outlook for tariffs or the tariffs have yet to sort of work their way through, and given the weakness in the American labor market, are you on side with the cut that you saw by the U.S. Federal Reserve yesterday?
Yeah, I think it was the right decision. It was certainly widely expected. And I view it as the completion of an insurance policy, or sometimes called risk management kind of posture of policy, to build some support underneath the labor market so the labor market does not deteriorate further. I do believe, however, in 2026, there's going to be more attention on the inflation picture. And that, of course, is tied, at least on the good side of inflation. It's tied to the tariff policy.
Let me ask you also about the announcement by the chair that they're going to buy Treasury bills, and I'm wondering what you made of that.
Well, I don't think it's quantitative easing all over again. I buy the argument that this is really reserve management or balance sheet management. It's temporary. It's supposed to run through tax day, April 15th. They're simply going to ensure that the overnight money markets are liquid and are stable, and therefore it's a temporary measure. It's not something that is aimed to try to stimulate the economy.
Do you think it's clear what the path forward will be for rate cuts? And I ask because, of course, there will be a changing of the guard next year. And Jerome Powell set out that the bar would be higher for rate cuts in the future. But anything could happen if you have somebody else leading the Federal Reserve.
I think that's true. Well, it's starting mid-year, we'll have a new chair. And so how that chair leads and what the committee decides could be different than what would happen under Chair Powell. The best we have at the moment in terms of an outlook for rates is the summary of economic projections that was published yesterday. And this is a conjecture at the beginning of the year. It's not something that's very firm, but nonetheless, a majority, 11 of the 19 participants in the committee, saw one or fewer cuts in 2026, and 7 saw no cuts in 2026. So I think the committee, for the most part, is becoming more hawkish as regards inflation, and they want to wait and see how the data actually break over the coming months, but are inclined to give some attention now to inflation.
And I was going to say, you think it will be about inflation next year as opposed to jobs?
One hopes so. One hopes that the employment markets don't deteriorate. It will depend, of course, on how the economy actually behaves. But if you can take today as a starting point, I think there will be more attention to inflation in 2026 than in the last few meetings.
All right, I will leave it there. Dennis Lockhart, appreciate you joining us on The Close today. Mr. Lockhart is an American economist, former CEO of the Federal Reserve Bank of Atlanta. Costco just released their 2026 first quarter earnings. We'll share that when we come back. Costco reporting earnings after the end of the trading day. Let's take a look at what they had to say. First quarter results, total revenue coming in at $67.31 billion. That's an 8.3% year-over-year increase, and above the estimate of $67.07 billion, which was the Bloomberg consensus. Net sales coming in at $65.98 billion. That's an 8.2% increase year-over-year, and a beat of the estimate at $65.77 billion. Membership fees, a key metric here, $1.33 billion, so a 14% year-over-year increase. The estimate had been for $1.29 billion. Earnings per share at $4.50 versus $4.04 in the same period last year. The estimate had been for 428, so a beat for Costco there. And then total company comparable sales, so including gas, 6.4 versus 5.2%, so year over year beat, and a beat of the estimate of 5.84%. Okay, let's get to Michael Baker, Senior Research Analyst at D.A. Davidson. He joins us to go through the numbers. Thanks for joining us today.
Sure, happy to be here.
So we get a bit of a preview from Costco because they released the monthly sales number. So what stood out from the earnings report you saw so far?
Right. The sales numbers were largely known and very strong, but relative to tonight, we sort of knew that. So in the press release, in terms of the new news, we saw a number of positive factors. First, as you said, the membership fee income not only beat consensus, but stayed in that mid-teen range, 14%. That's a really strong number. Some of that is due to the fee increase that they took about a year and a half ago. But what that is telling us is that there hasn't been a lot of churn, if any churn, from that fee increase. So that was certainly a positive. Gross margins were pretty stable at 11.3%. That was flat versus last year. That's what we were expecting. And total profits, or EBIT dollars, as we call it, up 12%. That also was an acceleration from last quarter, which saw 10% growth and was ahead of estimates, which were closer to 11. This is now the fifth quarter in a row that they've grown their profits in the double-digit range. So things are going pretty well for Costco.
I'm wondering if you see any key differences in the business in the U.S. versus the business in Canada.
They've both been pretty strong. I think Canada had a little bit better same-store sales, somewhere, I believe, in the 8% range. But U.S. was 5.9, just about 6%. All that excludes currency and gas. So both equally strong. They're really doing well throughout the world in terms of the top line. I can't think of any place in the world where they're probably not taking market share and growing their sales.
How do they handle tariffs? Because it's a company that has businesses on both sides of the border. How have they managed their way through that?
Yeah, they're pulling the levers that we've seen a lot of retailers pull, which is to change country of origin in terms of their sourcing, move to different products that are not tariffed, in other words, more domestic products, raise prices where needed, push back on vendors to try to get better costs, all the usual mitigation factors. And like we've seen for a lot of retailers, while there's some impact, it's probably pretty minimal. We think they've done a really good job offsetting a lot of the issues. By the way, for Costco, we also saw that they recently sued the administration to try to get some relief on some of the tariff costs that they've already spent. We'll see what comes of that.
Have they ever put out a number, Michael, of how much tariffs have cost them?
Not a specific quantification, no, because to be fair, it's really hard to get to it because, again, there's all those mitigation factors. So whatever the tariff increases are, whether it's 20% in China or whatever it might be in another country, they're certainly not absorbing the full amount of that because of all those levers that they've been able to pull.
What has been working well for them in their growth? Are they just sort of selling more to the customers that come through? Are they just, we looked at membership, are they just getting more people to join that model of business? What has been working for the company?
Well, yes, and yes. Opening more clubs, so that's helped. More clubs means more members. They're also seeing increases in the membership for existing clubs. And then people who have been members for a long time are increasing their spending. And I think that's a function of a focus on value. We know that the U.S. consumer right now is very focused on value, and the clubs do offer value. But Costco, we always give them credit. They're just great merchants. And there's that wow factor at Costco where you walk in maybe to pick up some basic needs or groceries or stock up on paper towels, and you see some general merchandise or some other, maybe more of a want than a need that you didn't know you need, but now you can't live without at a great price. And they do a really, really good job with that kind of merchandising. And that's always driven a good part of their sales growth.
Yeah, you think you're going to spend $50, you spend $300 when you leave the store. Okay, let's talk about the holiday season. I'm wondering how much this is a push for the company. We know a lot of retailers rely on the holiday season sort of to push them over the line. Is Costco one of them?
Well, the term Black Friday comes from, of course, in the past, that's when retailers would turn from the red to the black and start to turn a profit. Not really the case with Costco. They turn a profit throughout the year, of course. And relative to other retailers, the holiday season is not quite as important as a percent of the full year for a company that does sell so much basic product throughout the year. All that being said, sure, the holidays are important. The holidays are important for every retailer, and in Costco, no different. So we do think we'll ask them on the call tonight what they're seeing in the holiday season, and I think that'll be important. From the sales that they've reported, it feels like it's been pretty strong, but we'll get a little bit more color. One thing that's interesting is we do know, because of tariffs, and to go back to one of your previous questions, they've imported a little bit less in terms of merchandising this year than they have in the past. So that's a little bit less trimmetry, a little bit less holiday decorations, most of which is imported. And they've done that to try to mitigate the tariff impact. So maybe a little bit less specific holiday merchandise this season, but still we expect them to lean into holiday gifting and that type of thing pretty heavily.
Michael Baker, thanks for joining us on The Close. Michael, Senior Research Analyst at D.A. Davidson. Next, how are Canada's provinces stacking up when it comes to tackling the housing crisis? Back in a moment. A new report is evaluating how provinces and municipalities are managing the housing crisis. We were joined by Mike Moffat, founding director at Missing Middle Initiative, and we kick things off with what their organization aims to achieve in housing.
We're a think tank housed at the University of Ottawa that looks at housing issues and any issues relating to Canada's middle class.
Right. And I think part of your work, though, has been on young people and how housing in particular, they've missed out.
Yeah, absolutely. That we've seen over the last couple decades, things get harder for young middle-class Canadians, and most of that, not all of that, but most of that is revolving around housing. That we're seeing home ownership rates fall, young people having to live with their parents longer, getting priced out of our big cities. So it's a top of mind concern for us at MMI.
And what is this middle housing that you think we need to build more of? It's triplexes and duplexes, for example.
Well, it's more of everything, but certainly we need more what we call family-sized housing. We've been pretty good over the last 15 to 20 years of building, one-bedroom condos and things like that. But where we're really short are kind of three-bedroom homes, the kind of place where a couple might be comfortable raising a child or two.
So this report, what criteria did you use on, give us one or two, there are many, I know, but what were you trying to achieve with this report when you compared the provinces?
Well, we just wanted to look at how different provinces were doing. So we got 36 different indicators revolving around both policy, so the types of policies that they were implementing, and outcomes, what are they achieving? And interestingly, we found that provinces did best, not so much by implementing good policies, but by avoiding bad policies. So things like high development charges, high land transfer taxes, and so on. They seem to be negatively correlated with outcomes like young people being able to buy a home and affordability and so on.
Let's look at the provinces that you think have been doing a relatively good job, starting off with New Brunswick and PEI, the two Atlantic Canadian provinces. What in particular, why have they been achieving goals, do you think?
A lot of it is just they're getting out of their own way, that they're not implementing a lot of policies that are, again, harmful taxes. If you look at a place like the city of Toronto, they've got hundreds and hundreds of planners, hundreds and hundreds of policies, and everything's coded in red tape. Charlottetown, on the other hand, yes, it is smaller, but it just gets stuff done. There's fewer studies that need to be done and so on. And again, that was a big theme of the report, that, cities and provinces tend to be their own worst enemies when it comes to housing.
What, they just too much procedure, too cautious, for example?
Too much procedure, too cautious, absolutely. Taxes that are too high. that provinces that find ways to build infrastructure cheaper and kind of spread that cost fairly across society tend to have much better outcomes than places like Ontario, where we load all of our infrastructure costs onto residential mortgages, which is both an unfair but also a very expensive way of building infrastructure.
And that's, of course, because of these infamous development charges imposed by municipalities.
Yeah, absolutely.
Alberta doing quite a good job. Is that again because they tried to keep red tape to a minimum?
Yeah, absolutely. That Alberta does particularly well on creating new supply. So this isn't just a case that provinces with slow population growth are doing well. That Alberta is growing faster than anyone, but still able to keep supply up because of that, avoiding red tape and keeping taxes relatively low.
Let's get to the underperformers, and we better jump to Ontario. You're giving the province with the biggest population a D. What is Ontario doing wrong? Because we know that, last I looked, the housing starts were falling in Ontario.
Yeah, absolutely. So Ontario has the highest development charges. We have among the highest land transfer taxes, which causes existing homeowners not to downsize on their home. We have the longest approvals process. So Ontario really gets into its own way when it comes to housing. And both Ontario and BC do a lot of what we call kind of irrelevant policy. So instead of focusing on taxes and reducing regulations, they're doing stuff like foreign buyers taxes and short-term rental regulations and things like this, which can sometimes be helpful, but they don't attack the core problem.
It's interesting. I mean, in Toronto, I guess other communities, if somebody wants to put up a duplex, they have a big hearing involving local residents. I wonder, do we really need to do that? I think the neighbours should have a say, but I don't see why people several doors down the street, they have to be listened to.
No, I don't either. That I think we should make straightforward rules and abide by them. And that's, that tends to be the approach in Atlantic Canada, outside of perhaps Halifax, where they set straightforward rules. And if you comply with them, you can build. And if you don't comply with them, you can't. Rather than making everything so subjective and such, needing all of these hearings and so on.
Well, I know I'm generalizing, but apparently at these meetings, you get a bunch of old, comfortable people who've paid for their houses years ago coming out and saying, oh, no, that would destroy the area.
Yeah, absolutely. I love attending. I mean, I'm close to 50, and sometimes I'll be the youngest person in the room by about 20 years. So that absolutely happens. And you can understand why that, if you are able to reduce competition in your neighborhood, if you are able to keep the number of homes relatively low, that's going to make your home more valuable. And, people as well want to keep their neighborhood unchanged. And I can understand that instinct, but it is blocking young people from ever able to own a home of their own.
Mike Moffat is the founding director at Missing Middle Initiative. A recap of how we ended the day on Bay Street and Wall Street, another record close for the TSX Composite. It gained 169 points today, or more than half of 1%. To end the day at 31,660. The S&P 500 also in record territory today. It only moved 14 points on the day, but still that was enough for a record of 6,901. The NASDAQ dropping 60 points today, or about half of 1%. We had some earnings report after hours. Lululemon, one of them. The chief executive officer, Calvin McDonald, is actually stepping down at the start of the new year. So that company will be looking for a replacement. Their earnings weren't bad, and stock moved up 10% in the after hours, sitting today at 206.38 at this hour. Let's get to Broadcom. It reported after the end of the trading day as well, stock moving up more than 3%. The chip company gave a strong revenue forecast for the current quarter, signaling demand for the AI data center equipment is fueling their growth, and they have been beating analyst estimates. Costco also reporting today profits rose more than expected at that warehouse retailer, a sign that shoppers are still trying to find the good deals. That does it for the close. Thanks for joining us. We'll see you back here tomorrow.